I'm Thomas, and we're just about to do Financial Accounting Chapter 8 Intro Exercises. Okay, so let's go ahead and I'll share my screen. And I have the Cengage Basic Exercises open for Chapter 8. And we have 6 problems to complete to introduce you to the information in this chapter. Now, this is, once again, we are working with assets and taking a deeper dive into each asset. And this is going to be about receivables. So just to refresh your memory, receivables is an asset. You can have accounts receivables. You can have notes receivable. You can have interest receivable. Anything that's a receivable means you're supposed to receive it, but there's always a chance that you won't, no matter how careful you are about giving credit to a customer, right? There's always a chance that you won't receive it. So remember, so here's accounts receivable, okay? And I talk about this in class a little bit. So each receivable is different depending on the industry that you're looking at. So for example, in El Dorado, if you were to go to the hospital at Susan B. Allen for an injury or because you were sick, they're going to treat you whether you can pay them or not. And in the medical field receives about 50% of their receivables. So the other way to say that is for every dollar of receivables they have, they are going to collect about 50 cents on the dollar, or you could say that 50 cents of every dollar collectible is uncollectible. Okay, so we have to think about the idea of a certain number of accounts or percentage or something can be uncollectible. So how does the accounting industry handle that with recording an account that's not been paid, right? We have not received it, right? So for example, this is Susan B. Allen, and I know this is a very small number for a hospital, but let's say they have accounts receivable of $100,000. Then this contra asset that goes with accounts receivable, this is called the allowance. Okay, there's a method that you don't have the allowance, but we're going to focus on the method that you do have the allowance. And then within that allowance method, we have 2 calculations of what's going to be sitting in this account, all right? The other thing is that when you have both of these accounts on the balance sheet, you will then have a subtotal where this one gets subtracted from accounts receivable for what's called net realizable value. So this is a better picture of what you anticipate you'll be receiving, because if you let accounts receivable sit there and don't write anything off for a very long time, then your accounts receivable can actually become very overstated, inflated, whatever you want to say. But you can make that, because an asset is a positive thing, and just like inventory, some inventory becomes obsolete. Some accounts receivables are no longer receivable. So you have to be mindful of how old a receivable is. Okay. So the first thing we're going to learn is what's called the direct write-off method. Now, the direct write-off method does not have this allowance account. All right. So here we go. You don't see that allowance account at all without using the allowance account. Now, GAAP isn't too happy with this one, right? So this is not GAAP approved. But smaller businesses can do that if they don't have to follow GAAP exactly. So let's look at this problem here. So once again, here's your accounts receivable. It says that we have received $450 from Sean McNeely and wrote off the remainder of $860 as uncollectible. If an account box does not require an entry, leave it blank. So we're going to write off this account. Okay, so here's what they said. They said that we received payment of the cash. Okay, so cash is coming in, and then we're going to write off the remainder. So let's show cash coming in. We know that's going to debit, right? And then we're going to debit bad debt expense for the amount that we're writing off, which is $860. And then we're going to make accounts receivable zero out. So what does it take to zero out accounts receivable? It takes $13.10. Now I went ahead and put the beginning balance. You said, where'd you get that at? Well, you add $450 and $860 together, you get a beginning balance of $1,310. Okay, so I like to try to sometimes show you a little more of the story than what they say. Okay, so in my humble opinion, they should have said that this account had a beginning balance of. Okay, so I like to show that. All right, so let's just double check that we've got it. Now, once again, this is the direct write-off method, which means we do not have the allowance to use. We write it directly off to bad debt expense. Okay. All right, now you want to reinstate this account because you've received $860 check in the mail, so we're not going to send it back to him. Okay, so we're going to reverse the write-off. So when you reverse the write-off, it's called reinstate. So here's writing it off, and here is reinstating it. And then this is the offsetting reinstatement. So we're putting the $860 back in accounts receivable. So let's do that. And then we'll get rid of it out of bad debt expense because that's where we put it. Okay, there it is. It's now been reinstated. We just reversed the part of this write-off here. Now, once again, this was March. Now it's July 29th. Okay, and like I said, sometimes you get an account that decides to pay you, or customers that decide to pay you, and you've already written them off, and it's not like you won't take their payment, so you've got to put it back before you accept the payment. All right, so now cash is going to go up. There it is for $860, and then we'll pay off that account so that now this account has zero in it. Okay, so we had to reinstate it first and then accept the cash. And now his account is paid in full. Okay, his account is paid in full. And there you have it. So this is the direct write-off, no allowance whatsoever. Okay, just whenever you write off, you just credit accounts receivable and debit bad debt expense. Okay, I guess the good news is if you have to write off an account and you're not going to be receiving it, then at least you can turn it into an expense to offset some of your revenue. Okay, so, all right, now we're going to use the allowance method. So this allowance method uses an account called allowance for doubtful accounts, and this account is used for an estimate. Okay, an estimate is basically an educated guess of how much you think we need to allow, right? To allow, that's what an allowance is. How much are we going to allow for doubtful accounts against accounts receivable? All right, so this is another one, but it's not the same one. So on March 17th, we received $250 from Sean McNeely. So $250 is going up in cash, and it will go down in AR, okay? And then it says, wrote off the remainder owed of $550 as uncollectible. So here's the write-off. Now, without the allowance, we would have had to debit bad debt expense. But with the allowance, we now can debit the allowance account. Okay? And it's going to count against whatever the estimate is that we have created. Usually you create an estimate at the beginning of a year or beginning of a month of how much you think you won't receive. Okay, so let's go ahead. Let's put this cash coming in for $250, and then we're going to write off the rest to the allowance account of $550. And then, like I did for the other one, $250 and $550 makes $800 was in his beginning balance. So that's how much we got rid of accounts receivable, so that the account has 0 in it. As of 3/17, the account has been written off. Okay, but just like in the before problem, it's now going to be July 29th, and we're going to receive $550 in cash or as a check in the mail, and we will reinstate that account. So we're going to put it back in accounts receivable, what we wrote off, which was $550, and we're going to take it out of the allowance by crediting it. Okay, and now we will receive it. So we're going to debit cash and credit accounts receivable. But you have to reinstate it in order to set up accounts receivable to be paid off. Okay, so we didn't touch bad debt expense at all here. Nope, and we wouldn't. We would only touch bad debt expense for an adjusting entry. Okay, and we're going to be learning that, right? Up here, every time when we wrote off something, and then when we reversed it, we affected bad debt expense. Okay, but with the allowance, it takes its place basically, and we put, when we need to put a debit in or when we need to credit this account, we go back and forth. But most of the time, for this account to counter this one, it's going to need a credit balance in it when we do the balance sheet. If it has a debit balance when we do the balance sheet, that would actually add to accounts receivable, and that wouldn't be right, because this is supposed to counter, so it's a contra asset. Just to remind you, it's a contra asset. So it has a credit balance. But wherever this one is shown on the balance sheet, this one will be shown immediately afterwards to reveal the net realizable value of accounts receivable. Okay, let's go to number 3 now. Okay, so we're going to stay as much as we can with this allowance method. And then within the allowance method, there are 2 ways to calculate bad debt or the allowance, right? So percent of sales. So we're using the allowance method. Yeah, so I'm going to call it the allowance method, and we're going to use percent of sales calculation. So I changed the wording. One's a method, one's a calculation. So here's what you're going to do. When you use the percent of sales method, what does it find? It finds bad debt expense. Okay, so at the end of the year, accounts receivable has a balance of $495,000. So there it is. There it is. Has a credit balance of $4,500. So I've got it in there. And the sales for the year were $2,230,000. Okay, says bad debt expense is estimated at 0.25%. All right, so if you change that to a decimal, it becomes 0.0025. And when you take the amount of sales times 0.25%, you get a pretty low number, right? 5,575 compared to 2,230. So here is the amount of bad debt expense, and this is the adjusting entry, right? So we're going to put a credit in the allowance account, and we're going to debit bad debt expense. Okay, so here is the adjusting entry, and we'll do this every month or every year. Depends on, this is at the end of the current year, so this is at the end of the current year. Yep, there's where it says it, at the end of the current year. So there is your entry to make your adjustment. Now notice, we didn't worry about how much this balance is and whether it was a debit or a credit. We just simply said, well, bad debt expense is going to be this much, and we put it in as a debit, and then we use this account to offset with that credit. All right, so here is the amount of the adjusting entry. Okay, now this adjusting entry did not affect accounts receivable. Accounts receivable is still intact. Okay, it is what it was at the beginning, 195,000. However, we added a credit to our allowance account. So now our allowance account has a new balance, and bad debt expense for the year is $5,575. Okay, the net realizable value of the accounts receivable. It's the accounts receivable minus its credit balance in the allowance account. So when you subtract that, you get 484,000. 484,000, and I'm going to have to go use my back button here. Just a second. Because I want to put that back. Yep. There it is. And now I can go back where I was. Okay. So the net realizable value ends up being the difference between accounts receivable and a credit balance of whatever that allowance has in it. Okay, so once again, bad debt expense uses to find your bad debt expense without worrying about how much is in this allowance. You use the percent of sales method. You simply write down what the sales were. There's either an industry standard or history of your company about how much is expected to be bad debt. Okay, so if this was the medical industry, we would expect the medical industry to be 50%, right? 50%. So if I take this number out, yeah, you're looking at 50%. Look how much 50% would be. Wow. So no wonder medical charges are so high, because if you only receive 50 cents of every dollar, you're not going to get much. All right, let me put this back where it was so we don't get more and more confused. Okay, so then the net realizable value, let me color that green so that we know we've done that. All right, so once again, that's the percent of sales calculation under the allowance method. Now we're going to go to GAAP's favorite. So let me put GAAP likes this one. Okay, so I'm better than the direct write-off method. GAAP prefers using the allowance method. That way, you're at least looking at the idea of your receivables. There is an uncollectible percentage that you probably won't receive. Doesn't mean you always will be that way. All right, so the next one is the allowance method, but now we're going to use the calculation. Okay, another calculation. This is called analysis or aging receivables calculation. And it requires an aging the receivables table. Okay, aging the receivables table. This is the one GAAP really prefers. I put it in pink. GAAP loves this one. Okay. What we do here when we analyze the receivables or we age the receivables is we're actually trying to find the balance that we want in this account. Okay, the balance. So we're going to have to do an adjusting entry. I'm going to make this a certain color here. Okay, so let's see here. At the end of the year, accounts receivable has $480,000 in it. The allowance has a credit balance of $4,500, and the sales for the year are $2,160,000. Now they're going to put both of those on there because they're trying to see if you understand that aging the receivables method doesn't even worry about sales. Okay, we're going to use the aging method. The balance of the allowance for doubtful accounts has been estimated at $22,100. So this is the number from aging the receivables. Okay, so adjusted balance from aging the receivables. That's the method or calculation, aging the receivables. Okay, so whatever they tell you is the estimate, that is what you want to be in this account. So if you start with 4,500, right? So determine the amount of the adjusting entry for uncollectible accounts. It is not the estimate. It's the amount that it's going to take to credit this account to get us to 22,100. Okay, so if we've already got 4,500, how much does our adjusting entry need to be? So you take the balance and you subtract what's already in here on the credit side, and it turns out to be an adjustment of $17,600. And when that adjustment goes in here as a credit, then we're going to offset it in bad debt expense. So that adjusting entry, and remember the adjusting entry will be at the end of the year. So we wait till the end of the year to put bad debt expense in. Okay, so that's fine. So now let's answer this. Accounts receivable has $480,000. The new balance in the allowance account is $22,100, which is what that aging the receivable schedule told us that we would need to put in. And then bad debt expense has $17,600. If you remember, an expense account will goes through the closing process, remember? So it's going to get zeroed out every year. But accounts receivable and this allowance that goes with it, these are balance sheet accounts, so they do not get zeroed out. Okay, so now we want the net realizable value of the accounts receivable. So we start with 480,000. We subtract the balance in the allowance account of $22,100. That's on the credit side. And then when you subtract it, you get $457,900. That's the net realizable value. Okay, net realizable value. And so we want it to be green here. Okay, net realizable value is when accounts receivable and then the allowance gets netted, right? Accounts receivable gets netted with the allowance, and it brings it down to a more realistic picture of what we think we can receive. All right, two more, and then we'll be finished with the beginning exercises or the intro exercises. Okay, so now we're going to look at a note. And now we're going to look at a note. A note receivable is usually thought of as longer than accounts receivable. Notice this one says prefix supply company received 120-day 6% note for $72,000. It's dated on April 12th from a customer on account. So what happened was they had a customer that needed to take longer than an accounts receivable normally is. Accounts receivable is usually within 30 days, maybe 45, maybe 60 days, but usually beyond 60 days, it could become a receivable, okay? So some businesses can work out turning their accounts receivable into a notes receivable, and it will involve interest, and it will give them a longer amount of time to pay it. So the date of the note is April 12th. So part of this chapter, make sure you understand how to count the days of a month to see how old something is, or to know the due date of something. So it just depends if you're going forward or backward. All right, so just to remind you, of all the months that have 31 days, it's January, March, May, July, August, October, December. So there's actually 7 months with 31 days. So if you said, well, all the months have 30 days, that's not true. Only 4 do. Only 4 months in a given year have 30 days. And then, February has either 28 or 29, depending on what year it is. Okay? So let's start off with, if you're trying to find a due date, then you move forward. If you're trying to decide how old something is, like how many days old it is, you go backwards. Okay, this one says determine the due date of the note. So it is April 12th. That's why it's important to put down the date that note was issued. Okay, the day the note was issued. Because you may say, well, 120 days. Well, every month has 30 days, so that's going to be 4 months from now. So that's May, June, July, August. August 12th. Well, if you guessed August 12th, you'd be wrong. Okay? You'd actually be late to pay this. So let's test it out. So you start with the month that the date or the note was created or issued. Okay? So then you have to think about how many days are in a month. There in April. There are 30 days in a month, and you subtract the date. And you subtract the date. That leaves us with 18. So there's 18 of the 120 days. And then May has 31, so there's another 31 days. June has 30. July has 31. And before we get to August, we want to calculate how many days that is before we get to the month we anticipate. Okay, so enter. All right, hang on just a second. There are 31 days. There we go. So let's do this. Equal the sum of, and now I'm going to run this across here. All right, so we're at 110 days at the end of July. So with 110 days, we need 10 more days for it to be 120. So August 10th is your due date, right? If you would have picked August 12th, then you've been 2 days late. Okay, 2 days late. Now, let's talk about a note. A note has interest. A note it matures in so many days or months or years, okay? And there's a certain amount of interest that has to be paid with the note, okay? So interest rates are stated annually. So when they say that the interest rate is 6%, they're saying that If this note was to go on for a whole year, we would pay 6% of 72,000, but it's only going on 120 days out of 365. So they tell us to use a 365-day year. And before, in our book, we were using 360 just because it was easier to divide. It was easier to work with, but we're going to go with 365 because that's what the real world uses. So you want to put your loan amount down. So how do you figure interest? Okay, interest amount is the loan amount times the rate times time. Okay, so let's put loan amount times interest rate times time or term. Okay, term and time pretty much means the same thing. Interest rate. I'll put term here. Term or time, whichever you want to say. But to calculate interest, right? To calculate interest, it takes the loan amount times the interest rate times the time. Always leave your interest rate intact. Okay, don't mess with it. So we've got 72,000 times 0.06. That would be if we had it for a whole year. But this bill, this notes receivable is supposed to be paid in 120 days. So the final piece of this is the term. And you take it 120 divided by 365. So here's how this gets calculated. It gets calculated by taking 72,000 times 0.06 times 120 over 365. So you know you've got to work inside the parentheses first, right? And then, so there's the amount of the interest. They want to know the maturity value. So the maturity value is the amount of the loan plus the interest. Okay, so this is going to be plus. Amount of loan plus interest is what maturity value is. So let's put loan repaid plus interest. Loan repaid plus interest. That's what maturity value means. So 72,000 was the note, and it's receivable to us. To our customer, it's a note payable. Okay, but to us, it's a receivable. So when we accepted the note, let's say we loaned them money for cash, we would put a notes receivable and make cash go down, or we would do a notes receivable and credit sales if we are allowing them to pay us longer than accounts receivable is usually. So here is the maturity value. So in 120 days, we will receive the amount of the loan plus the interest, the maturity value of $73,420. All right. So here we go. Here's when the note was created on April the 12th. And then when the maturity date happens, which is August 10th, it needs to be there by August 10th, we are going to receive the cash. All right, so let's show cash going up for the maturity value of the note. Okay, but then we have two other accounts that we have to credit. We're going to credit the note receivable, so interest never goes in the receivable, or at least not right now. Okay, we always keep the interest that we receive in its own revenue account called interest revenue. So we're going to get rid of the note receivable, and we're going to record a credit to interest revenue for the 1420. So in 120 days, we made interest revenue of 1420 as the lender or as a customer is taking longer to pay us, and we're adding interest to what they owe. All right, there's that. I think this is the last one now. Let me check this, make sure I've got it right. Okay. Now this is going to be an analysis. All right, so this is called accounts receivable turnover. Turnover for accounts receivable is how quickly are you collecting the money that customers owe. All right, so let's go with year 8. Okay, year 8 had sales of, and I put my sales here, and I put my inventory up here. I'm sorry that I have them kind of flip-flop. So the sales for the year is $6,844,000. The beginning balance of inventory, of accounts receivable, accounts receivable beginning balance, $540,000, and then at the end of the year, it's $620,000. Then we're going to calculate an average accounts receivable. So you add those two numbers together and you divide by 2 to get the average accounts receivable. Okay, let's go ahead and put our information in for year 9. So we have $8,302,500 as our sales. We have a beginning accounts receivable of $620,000 and an ending accounts receivable for $610,000. When you add those two together and divide by 2, you get $615,000 in average accounts receivable for the year. All right, so the first thing we're going to find is determine the accounts receivable turnover. Okay, the turnover. How many times in a year are you collecting your accounts receivable? Okay, so we're going to take sales and divide by that average accounts receivable. So year 8, okay, we're taking the sales of $6,844,000 and divide by the average accounts receivable of $580,000. So we are turning accounts receivable over in year 8, 11.8 times. Okay, and here is the calculation beside that number. Okay, so this number is how many times did you do this? So let's put that number here. Okay, now let's test it for year 9. Okay, year 9 is, the turnover is the sales divided by average accounts receivable. There is the formula. So this, for year 9, is a turnover of 13.5. So the more you can turn it over, the more quickly you are collecting your accounts receivable. So that is a favorable trend. Okay, so we're improving from year 8 to year 9. All right, now with this one, we're going to see how many days it's taking us to collect these receivables. And this will relate to these numbers. Okay, so how do you do that? You take your average accounts receivable. So what was in the denominator is now in the numerator of this formula. And then you divide by your average daily sales. Okay, so I've got this here. Okay, so how do you get your average daily sales? You take your sales and you divide by 365. Okay, so we're going to need that number for both year 8 and year 9, and we've already got the average accounts receivable. So now the days. So let's go to this one. Okay, so this one is going to take your average accounts receivable and divide by your average daily sales. Okay, and it says round intermediate calculation and final answers to 1 decimal place. Okay, so this is what it's showing. Okay, the 1 decimal place ought to be 30.9. Okay, but I think it rounds it to this, but I don't know. I've got to remember. I know something was wonky. So let me go ahead and take care of this. So let's put in for year 8, And it makes sense. If you take 11.8 times 30.9, how many days do you get? Let's see here, equals this times this. You should get about 300, there it is, 365 days. Yep, that number should be, and it'll be this way here. So our average daily sales is our sales divided by 365. And then our days in sales is the average accounts receivable divided by the average daily sales. And if we are calculating it right, then the turnover times the days should be 365. So there's a way to check if you're doing this right. And it is. So now let's see, how many days is it taking to collect accounts receivable? So it's taking 30.9 and 27.0. Now, this may not be right. Oh, it took it. Okay, that's good. All right, so what's happening here? We're getting quicker. We're turning it over more, and our accounts receivable are sitting there in less days than they were the year before. So this is favorable. Okay, the more quickly you can collect from your customers, the more favorable it is. Okay, that takes care of the intro exercises for chapter 8. Okay, so I am going to stop my share and say goodbye for now. We will see you on the next video.